If you're sitting on a concentrated stock position or planning a business sale in 2025, the old strategies of avoiding capital gains taxes just aren't going to get it done. The tax landscape has shifted dramatically, and most advisors are still using the 2020 playbook for 2025 problems. My name is Samuel Harnish, and I'm the founder of Quantitative Financial Strategies, where we specialize in tax-aware investing for families with $5 million or more in investable assets. And over the years, I've been helping clients navigate large liquidity events, diversify from concentrated positions, manage their stock-based compensation by using strategies that most advisors don't know about or just don't have access to. In this video, I'm going to walk you through some of the new ways that we're using to avoid capital gains taxes for clients in 2025, including some strategies that weren't even available or practical just a few years ago. So if you're facing a significant liquidity event this year or sitting on a concentrated stock position that's making you nervous, this could potentially help you keep a lot more of what you've built. So when it comes to a business sale, most financial advisors are still recommending old strategies, whether that's breaking up the sale into multiple years with an installment sale, maybe they add some sort of direct indexing, some charitable contributions, charitable remainder trusts, or maybe even funding a DST. And while these strategies can help, they're not as powerful and they're less flexible than some of the stuff that is available today. So the number one way that you can avoid capital gains taxes is by opening a long short separately managed account. And what this is it's similar to a direct index, which Parametric came out with in the 90s. It's not a novel concept. By having hundreds or thousands of individual stock positions, your ability to tax loss harvest is meaningfully higher than if I had just owned an index in an ETF or a mutual fund. The problem with that is that the tax loss harvesting benefits kind of go away over time. They call this ossification, when a portfolio kind of locks up and there aren't any more tax loss harvesting that you can do without having to put in new cash into the account. And this is where adding long and short extensions completely changes the game. So starting from the beginning, you just have more capital at work. So let's say you have a $10 million account. Well, instead of just buying $10 million worth of securities and being able to tax loss harvest those, you can add additional long positions, let's say $5 million more in long positions, and then you also add $5 million of short positions. Well, now you have a total of $20 million of exposure starting off of just the $10 million you funded the account with. And what that does is that gives you so many more positions that you'll be able to tax loss harvest. And importantly, the short positions will have much more capital loss harvesting opportunities as markets move up. Because the problem that a lot of people have in this extended bull market that we've been in is any capital that you've invested over the past year or 3 years or 5 years or 10 years, I would say substantially all of those positions are marked at a gain. So there's no more tax benefits that you can get from the position. Well, if you have a long short account, there are always going to be opportunities to harvest losses as you put new short positions on. And it's important to note that this isn't just better because of taxes, it's a better equity portfolio period. So if you had been running some sort of a parametric account, your expected outcome is to underperform whatever index it is that you're tracking. The idea of those strategies is to track as closely as you can to the index while getting tax benefits along the way. So by definition, your performance can only be as good as the index minus the fees you're paying for someone to do it. Now, when you have long and short, it's a completely different process. It's active. What you're trying to do is go long good stocks and short bad stocks and create an additional return stream on top of whatever your equity benchmark is. So it's a better solution just for equity portfolios in general, and then it can come with massive tax benefits. So depending on the size of the leverage or extensions that you use, you can expect anywhere between 30% to 90% of the account's value in the first year harvested in capital losses. And the beauty of this, unlike investing in real estate or your typical long-only direct indexing account, because the at-risk capital when you're shorting is infinite, you can actually harvest losses in excess of your original cost basis. So going back to the previous example, if you were to fund the account with $10 million, let's say you use really big extensions. So you went 300 long, 200 short. Well, at the end of the first year, you might have around $9 million in capital losses. And the next year, you might harvest another $5 million in capital losses. So that's a total of 14, but you started with a $10 million account. It doesn't matter. You still get to use all of those capital losses. Now you just start doing the math on this. If you were able to fund an account and the minimum is $1 million, but let's say you were able to fund an account before your business sale, there's no limit to how many years you can carry forward capital losses. So ideally you would want to start with this strategy as quickly as you could so that you're accumulating capital losses that you're just carrying forward into your business sale, which is a large capital gain event. And now you have capital losses that can be used to reduce the tax bill by offsetting against the gain when you sell. Now, a lot of people have the majority of their net worth tied up in their business. So it's not really an option to fund a multi-million-dollar account pre-sale to start this process. So what you can do is, as soon as you sell the business, and preferably earlier in the year because taxes are done on calendar years, let's say you're going to sell your business for $10 million. Well, if you could break it up into an installment sale, say 5 in 1 year, 5 million in the next year. Start the process immediately with the $5 million when you get it. Get pretty close to harvesting all the losses you need to offset the realization of a $5 million gain. Well, in the next year, you're going to realize the second half, the $5 million gain. And now you're going to have $10 million running the strategy, and you should have no issues being able to harvest enough capital losses to offset that second half. So there's different strategies and levers you can pull. Oftentimes we'll also set up some sort of a donor advised fund or something for someone to plug the gap in the amount of capital losses they weren't able to harvest to cover the wholesale. You can just make a charitable donation to your donor advised fund any charitable donations you want to make for years to come. But in this one big liquidity event tax year that you have, when it's most beneficial to get the deduction. Now, what happens after the business sale and after you've done this for the first year or two? Well, it's really up to you. And the beauty of this strategy is it's fully transparent, it's daily liquid, and you have full control. It's not something that's commingled with other investors. It's done directly in your own personal brokerage account. You can slowly unwind the strategy because there are embedded unrealized gains. If you don't want to trigger those, well, you can just go steadily over time while the account is still realizing capital losses. You use those losses to offset the gains you're going to realize to unwind the strategy. Or honestly, what most people do is they'll withdraw from the account tax neutrally over time as it's realizing losses. They'll take money out triggering gains, but they offset one another to create sort of tax-free liquidity from the account. But at the end of the day, for most people, it does make sense to have some sort of equity exposure, and this account can serve for just that. This strategy is also incredibly powerful for people with concentrated stock positions. Whether you were the founder or an early employee of a company that has just skyrocketed and the percent return on your shares is thousands and thousands of percent. It's a wonderful situation to be in, but it is a problem because in order to actually realize or take chips off the table, you're triggering massive tax bills because people in this situation, the cost basis is almost zero and the position is millions of dollars. So some people will look to use exchange funds, or they'll do the long only direct indexing, or sometimes they'll even just rip the band-aid off and sell the position and just pay millions in taxes, which I think is ridiculous. Or what you could do, the textbook best way with the tools available today, is to enter into something called a prepaid variable forward, which all that is you would work with a bank and you essentially collar the position, buying a put and selling a call, and clearly defining the range of outcomes or exposure that you have to the position. So let's say you bought a put that protected you on the downside after the first 10% drop in the security that you own. And then you sell calls that still give you some upside, let's say the upside of 20% for the position, and you structure it for over the course of 2 years. You've basically collared the range of outcomes that can be experienced with that position. So I have a $10 million stock position. I can only lose $1 million because of the put contract that I bought. I can only make $2 million on the position because of the call options that I sold. Now, what that does is it clearly defines the outcome and removes a lot of the risk that is inherent in a single stock position. Now a bank would be willing to give you a loan against that position as the collateral, and depending on just how much protection in the specific collar that you arrange for, that's going to determine how much that they're willing to lend to you. But if you do it right, they'll lend to you, let's say 90% of the position. Well, you take your $10 million stock, enter into this agreement, and what you get for that is you get $9 million cash. Take that $9 million and plug it into a long short equity account, which over the course of just 2 years can harvest well in excess of $9 million in capital losses. Fast forward to the end of 2 years when the contract is ending. Now it's time for you to deliver the shares. That delivery is counted as a triggering capital gain event. You're realizing the gains on the position. So you realize it, but you've also harvested over $9 million in capital losses, so it offsets it. And that is the best way to do 3 things. quickly diversify the position in 2 years, do it tax neutrally, so you're not getting this huge tax bill when you do it. And then third, and probably most importantly, you actually protect the value of the position. Some people that plug a single stock into, let's say like a direct indexing fund where it's just taking years and years to build up the capital losses to diversify. Well, in that time, the single stock that you own, it can drop 20%, 30%, 40%. And that value is just gone. It's lost forever. What the prepaid variable forward does is it locks in, again, depending on where you buy the put at, a substantial amount of the value. It's protected. Now, to do something like that, you have to have a large position, $5 million, $10 million in a single stock for it to be worth it for a bank to sort of create this arrangement. But if that's the situation that you're in, that is 100% the number one strategy I would be looking at doing if I were in your shoes. And it's something I can help you with. Now, some of you might be thinking, that's all great, but I'm also selling my business, or there's some sort of structure tied to my liquidity event that it's not all capital gains treatment. I see this all the time where maybe it's just half of the liquidity event is a capital gain, and then there's some sort of earn-out component where you're going to be paid a large bonus or salary based on you staying on with the business that you sold, for example. As great as the strategy is that we just discussed, those are capital losses which can only be used to offset capital gains. So if you need an offset or a deduction against ordinary income, there's a different strategy that you're going to want to use for that. And before we get to that strategy, I just want to make it very clear. I cover strategies like these in extreme detail with my clients at QFS, which is built for families with $5 million who are serious about tax-aware wealth building. This is a done-for-you relationship where we implement the specific strategies that you need for your situation. We work one-on-one and have access to some of the most ridiculous investment strategies out there and can build a portfolio that normally would only be available to someone with, let's say, $100 million. We can bring it to people like you for as little as $5 million. And we can't work with everyone because these strategies do require a significant amount of capital and a lot of attention to detail to make sure that they're being implemented correctly for each person's unique situation. And I've got a link in the description if you want to book a call and learn more about it. All right, back to the next strategy. So if you need to offset ordinary income, the way you can do that is what's called tax-aware hedge funds. And it's a somewhat similar process where positions are always being looked at. What is the after-tax consequence of if I hold this position or sell it? And sometimes a position, the manager will look at it and be, oh, actually the tax value of selling this would be more advantageous than what our model predicts if we were to hold it, just looking at the pre-tax return potential on it. What's different about this is if you use specific derivative contracts in a hedge fund that elects for trader fund status, the character of the trades get passed right through to the LPs, and there's a mismatch between capital gain versus ordinary income or loss on some of these contracts, depending on if you hold them to maturity or reset or exit them early. And what these hedge funds are able to do, number one, serve as a diversifying source of return in your portfolio that complements traditional stock and bonds exceptionally well. That's what the goal of a hedge fund should be. The problem with most hedge funds is you lose so much of the return to taxes that they have no place in a taxable brokerage account if you're a high income earner. What these can do is be managed tax efficiently so that you're deferring taxes until the eventual redemption date if you needed to take money out of the fund. And at that point, it would get long-term capital gains treatment. And if that wasn't enough, along the way, these funds are able to pass ordinary losses to investors while the funds are still making money on a monthly basis. So the way that it works is you would invest in the fund, and then at the end of the year, you're going to receive a K1 statement, the different tax characteristics of that the fund realized over the year. And the expectation is that there's going to be a decent chunk that is an ordinary loss, which you can then use against any sort of ordinary income you have. So even if that's just your standard W-2 or 1099 income, you can use it for that. Or in the example I was just describing where you're selling a business and there's this large earnout component that's going to be classified as ordinary, well, you can use some of your proceeds to invest in the long-short equity strategy that's giving you the capital losses, and then you might want to use some of your proceeds as well to diversify into a hedge fund, which is going to give you deductions against your ordinary income. And my favorite use case for this strategy isn't actually any of those. It's when we do Roth conversions. So most people understand that any sort of qualified retirement accounts you have, whether that's a 401k, an IRA, or some sort of deferred comp plan, that is all income that you have earned but not yet paid taxes on, and at some point in the future the government is going to force you to take distributions from it, which is not a good thing because you can't control the amount or timing of those distributions. And what happens is you can get moved into very high tax brackets very quickly if you have large multi-million-dollar retirement accounts. So what we do is your retirement accounts are over here. Here's your brokerage account. If you're able to allocate to some of these tax-aware hedge funds, you'll get these ordinary loss deductions. Well, what you can do is use those deductions to offset Roth conversion. So what I'm going to do is I'm going to move the assets in my retirement accounts over into a Roth, and that movement realizes the ordinary income that I've been deferring, and I move it into the Roth where it's never taxed again. Now, if I have the right allocation, or I'm choosing the right amount to convert on a yearly basis, I can construct a portfolio where we have, let's say, a $500,000 deduction a year. Well, that means that we can realize $500,000 in income. Let's say this is right after you retire and your income's dropped to zero. Well, I'm going to realize $500,000 in income a year in Roth conversions alone, because that way I'm be able to use this deduction that I have. Once you've gotten all of your retirement account assets into a Roth IRA, it's never taxed again, and importantly, there is no required minimum distribution, or RMD, where the government is forcing you to take money out. You can just keep compounding your wealth in there tax-free, and if you really wanted to, you could pass it to your heirs, and they get another 10 years to compound the investments in there before they have to take the money out, and there would be no taxes for them either. Now, the opportunities with these strategies are unbelievable, but it can also be overwhelming, and I've seen dozens of people that are not using them correctly, or they're using them suboptimally and not really taking advantage of looking at someone's holistic picture, which is, it's not what's going on this year, it's what do we expect to be going on over the next 5 years, over the next 10 years, because frankly, to optimize it correctly, you really need to look at the different strategies available, the different accounts you can hold them in, and which ones will be most beneficial to your specific goals. Now, I just gave you a lot, but here's the reality. You can't just watch a YouTube video and then go set up a complicated tax loss harvesting account and private investments and hedge funds and things like that. You're probably not even able to call up your local advisor and have them implement these strategies. Maybe they're great, and I'm not looking to talk down on anyone, but a lot of them have never even heard of some of these approaches. And if you try to do this for yourself or with the wrong advisor, you could end up doing a lot more harm than if you had just done something simpler in the first place. That's why at QFS, we only work with families who we feel would actually benefit from a relationship with us. Not because we're trying to be exclusive, but because some of these strategies have certain requirements to make sense, and frankly, that's where we can provide the most value. If that's you and you're facing a significant liquidity event or sitting on concentrated positions that are keeping you up at night, then I'd encourage you to reach out. Click the link in the description to book a consultation call. We'll talk about your specific situation, and I'll walk you through how we can build a plan to help you keep significantly more of what you've created. But even if you're not ready to work with us yet, go ahead and subscribe to the channel, where I'm going to be talking about more strategies like this that the average advisor isn't going to tell you about. Thanks for watching, and I'll see you in the next video.